You're such an asshole.
Hello everybody, hello children. We gotta bang this out so I can go out and enjoy the day. Hi Aaron, hope you're all well. Thank you for your input on my previous question. It has helped me inform my decision and looked at what we discussed in a different way. That said, concerning cryptocurrencies, I made a decent profit off Bitcoin, having bought in the 2015 lows when it was roughly $230, then sold it when it was $2,700 a few weeks ago. Alright, so you had a tenfold increase. That's more than a little bit of profit. That said, I want to get your input on a video request I have concerning investing in alternative investment vehicles beside cryptos. As you may remember, I asked you about the application on Benjamin Graham's value approach in today's stock market. While we agree he may be right when there are normally functioning markets, it's safe to say it doesn't work in today's markets, barring some major recession or depression that wipes out the value of most of the major indices over the next few months or years. That said, I had a two-pronged question. First, I want to get your input on investors known as Joel Greenblatt and Seth Klarman. These are two value investors who, while they never met Graham, used a new approach to investing using the same philosophy of buying undervalued securities and cite him in their books as inspiration. For example, Greenblatt's book, The Little Book That Still Beats the Market, Greenblatt explains that it is best to look for securities that pay a high return on assets with low PE ratios, and preferably those that pay dividends as an evolved Graham approach. Well, I don't think that evolves too much beyond Benjamin Graham. I mean, it was okay. Securities analysis by Graham and Dodd is basically, for those of you who don't know, the Bible. I might even have that damn thing. No, I threw it away once I realized I was never going to read it. It's about that thick, and it's basically I wouldn't say the Bible, certainly the Bible, but more so where it was really codified. Where financial analysis, okay, what is the value of the stock? How do you put a price on a stock? What should it be? What are the things we analyze? And so that is probably the best book, even though it's about that thick. Still more interesting than When Atlas Shrugged. It's way more interesting and fast. So it was, I guess, maybe more of an academic study. But it wasn't like that he discounted dividends. You know, that certainly, you do look at dividends as ultimately being the final, that's all the shareholders get is dividends, really. So it wasn't like, Benjamin Graham said, fuck dividends. But yeah, it's also the same thing, low PE ratio. So I don't know how much more evolved Greenblatt's book is beyond Benjamin Graham's. He also has a website called Magic Formula Investing that acts as a screener for companies that fit the criteria of companies he looks for. My question is, would you consider this a viable or reasonable approach to value? If why not? Is it? Yes, it is. It absolutely is 100%, because a PE ratio is price. You take the price of a stock, you divide it by the earnings. That ratio tells you the real price of a stock. That's how it was in the past. That's how it should be today, and how it's how it still is. It's just the market doesn't recognize it. And the market is irrational. The market, as you know, is being driven by monetary policy and money flooding the markets and low interest rates and corporate buybacks, and not reasoned, rational, or I would like to say empirical isn't the word, formulaic, not fundamentally what the value of the stock is. Now, some people would argue, oh, well, with all this low interest rates and all this money, it's a very less, and the stock market has been less volatile, so the beta has gone down. So according to the CAPM market, it's actually adjusted for, it's like, shut the fuck up. But it is, hang on, where'd it go? I want to, is this a reasonable approach to value? Yes, it is reasonable. But this is not whether Greenblatt or Benjamin Graham or Peter Schiff are reasonable people. They are. You and I are reasonable, sane people. All right? The market is not. The market is fucked. Now, I understand, according to computer models, and if it just keeps on going, they spread off more money. Well, yeah, in a Zimbabwean or Venezuelan stock market sort of way, the stock market will continue to go up, but that's because of hyperinflation. That has nothing to do with earnings going up or dividends going up or cash flow. So we, in a odd sense, we are wrong. The fundamentalists, the value seekers are wrong because we're like, I'm not paying a PE of 30 or a dividend yield of 2%. I'm not buying a stock for a 2% dividend yield. And people would say, oh, well, look, the stock market went up. Well, I'm not in the business of capital gains. I'm in the business of investing. I want my fucking cash flow. Because maybe not today, maybe not tomorrow, but someday someone's going to wake up that has more money than me. and they're going to poke the bubble. They're not the bubble. They're going to poke the market and wake it up from its irrational slumber that it's in. And they're going to, hey now, why should I pay? Why would I buy 2%? That barely beats inflation, which is every dumb fuck throwing money into their 401k. No, but I don't want to break up the party like I tried to do the dot-com mania and the housing bubble. I'm just going to let you fuckers fuck up this time. So, are they right? Yes. Are they theoretically right? Are they fundamentally right? Are they empirically right? Yes, it is a way to approach value. But today, as you know, the market has changed so fundamentally that this no longer would apply. You would have a better time, I wouldn't say investing, I would say speculating in the market, trying to predict new supply of currency, money supply being printed off by central banks. You'd be better off trying to predict risk and corruption around the world, and how much is that going to flood British, Euro, and American dollar markets, and therefore affect our asset values. So it's sad, but the works of Benjamin Graham, Dodd, Greenblatt, anyone else, it's academic now. It still helps. Like, yeah, if I had the choice of going into the market, I'm still going to use fundamental analysis. I'm still going to look at the fucking PE ratio, and I'm still going to look at the fucking dividend yield. I'm not going to look at the PEG ratio. I'm not going to look at these dipshits. Well, earnings keep, like, Starbucks is my favorite. My God, I looked at their PE ratio once. I'm like, what makes you so special? Because you guys are going to keep growing? Where are you going to grow? When is your growth going to end? You sell fucking coffee. So, but still, you could still use this to find a stock that pays a dividend yield of 4% and it has a PE ratio of only 20. And okay, so you get a 4% rate of return, but it's still, since Schiller's been tracking the data since 1871, I'm sorry, I'm using that as the barometer. I want a dividend yield of at least 5% and a relatively risk-free quality stock. And you're just not going to get that. And here's the other thing. I've mentioned this before. This is all publicly traded. I think there's going to be a huge push towards entrepreneurship, privately held companies, maybe hedge funds that invest, some other funds that invest in private, because the money isn't flooding in there. It's only because these securities are publicly traded that it now has access to pension money, 401k money, IRA money, Coke plans, simple IRAs, simple 401ks, all that other stuff. So in my own personal life, the fuck if I'm going to invest in the stock market and get 2%? That's for you fucking sheep and dipshits that think it's different this time. All right? I'm investing in the sale of my books. So I spend money on marketing. I usually get about a 20 to 40% rate of return. Paying off your debts. That's a zero risk investment. And depending on the interest rate of your mortgage, that's a guaranteed 4 to 5% rate of return. Paying off your student loans. Well, there's another one. Paying off your auto loan. That's for risk-free investments. Paying off debts is where I think the future for retirement, at least in the medium term, will be. But down the road, I think it is entrepreneurship because the rates of return, either in individual entrepreneurial endeavors, if you do them smart and right, or private investments like the peer-to-peer lending entities, stuff like that is not tainted with this publicly traded and therefore easily attracting investment money. I think those are where you're going to get your higher rates. So that's where you really invest, because it's like, oh, I give you 100 and you give me back 10 every year. That's a 10% rate of return every year. That's a good deal. I'll take that. But the harder part is it's not publicly traded or it's not publicly available information. So you got to know people that are investing. You yourself have to invest. There's a lot of time and labor investment in it. Anyway, I know I'm going off topic, but it's just, I'm just telling you, trying to give you context as to just how insanely overvalued the stock market is, and where I think maybe there's some good deals where you can actually find real investments. Shit, fucking going to get a degree in engineering or going to trade school is a better investment right now than the fucking S&P 500. As long as it's affordable. Also, my question was, would you consider viable and reasonable? If, why not? Okay, so we answered that one. So yeah, it still is. It's very reasonable. It's a viable approach even today because, okay, you'll get a slightly better deal. You'll get a 4%. But in the grand scheme of things, today it's obsolete as it applies to the publicly traded markets. It would still apply to private, though. It's universal. It doesn't matter if it's public or public. Just means it's more liquid, and so you get more dollars chasing after a certain amount of stocks. These skills, these evaluation techniques, these analytical techniques that Graham, Buffett, all them follow would still apply to privately held companies. As a rule of thumb, you take off like a third of the valuation because it's privately held, not public. But so it's still there. It will fundamentally never change. It's just right now in fucking quantitative easing, 47 Janet Yellen world, it's academic and moot at this point. Also, my second question is more alternative investing, although it is inarguably some more speculation than actual investing. As I highlighted in my Graham video request, stock values are absurdly high by any normal metric of value as of today, January 3rd, 2017. That's a little old, don't you think? You mean July 3rd? The Schiller PE ratio is 29.7. Yeah, see, 30, almost double the historical average of 15, which even then would only indicate the stocks are fairly valued. Yeah, 15. The last time we were at 15 was at the dearth, at the trench of the 2009 after the housing bubble crash. That's where it hit rock bottom. And then I was like, okay, maybe I'll invest. But then that fucker went right back up. I'm like, no, I'm not. The stock market is for baby boomers and sorry. You guys go right ahead. My 401k! What? Which even then would only indicate that stocks are fairly valued. The only other times it met or exceeded this as was 1929 and 2000. And we all know how that ended. I would double check that again. I could have swore that the housing crisis, 2006, 2007, it was higher than what it is now. But yeah, you're right. Only in 3 points in time, the dot-com bubble, the stock market, the 29 Great Depression, and then I want to say it was 2007. I'm not going to look it up. We can look it up later. And we all know how that ended. And that this fact, in conjunction with rising interest rates and earnings recessions, to me would indicate that equities would have a hard time maintaining their current value. Oh, don't discount, don't underestimate the stupidity of the sheep in this country. And also don't underestimate the stupidity of the sheep in Wall Street. They make it seem like they're so smart. They are salesmen. They want this to continue. They're not investors, okay? They are not. This is why they can't beat the S&P 500. They don't, as long as new money keeps coming in, that means their portfolios grow. You got the 401k clergy telling you to throw all your money into the 401k and the IRA. You got pensions. You do not underestimate the stupidity and the lemming-like mentality of the American public. Right? It could go on a long time. Look, if they haven't figured out it's overvalued now, with PE ratios twice the historical average, you think they're going to give a shit about earnings? You think they're going to give a shit about interest rates? Interest rates maybe, because a lot of other, like if, say, the federal funds rate goes up, or LIBOR or Wall Street Prime goes up, that can have a cascading effect because a lot of other interest rates are affected by that, and then that might have effect on economic growth, what is financed, what isn't financed, what businesses get financing and not. But the American people, and especially the investment community, is so deaf and tone dumb to fundamentals. This won't matter. This won't fucking matter. I remember one time I did an analysis, this is a long time ago, and the decoupling between economic growth and the stock market. This is back, I think, even in, maybe it was the 90s, when I was like, dude, look at this stock, what's going on? And that was even when the economy was growing, too, under Bill Clinton. But yeah, no one gives a shit about fundamentals. No one cares. They want the party to go on forever. And then that way Wall Street guys can go, yeah, I'm a financial genius. It's like, no, you're just like sucking at Janet Yellen's teat. That's all you're doing. Maintain their current value. So my second question is, what are your thoughts on inverse ETFs? Essentially, these are investment vehicles are tied to short the market and would, as the namesake suggests, go the inverse of the market. Some examples would be SH, CHAD, SEG, ERYY, TCA, and FAS. Would you consider these instruments something that should be avoided completely, or if you're okay with throwing a few grand in there and be fine with it? Well, here's the problem. The old classic saying, the market can remain irrational longer than you can remain insolvent. And what you're talking about is shorting them. So like if the value of the stock market goes down, then you make money. But if it goes up, you lose money. Now, here's the problem with shorting something. The most any investment can go down to is 0. So there is a limited amount of gain you can have. All right? But the most a stock or any other investment can go up to is infinity. So what can happen is, let's say we have a hyperinflationary environment and the stock market goes up 1,000%. Of course, people over at CNN will claim it's a great thing. Oh, wait, no, Obama's not in office anymore. They'll blame Trump for hyperinflation. All of a sudden, they get really economic-y. So the point I'm trying to make is that when you invest in a stock normally, the worst you can lose is 100% of your investment. When you short a stock because it has unlimited potential to go up, in theory, and you're shorting it, that means you're risking it going up in price, so to infinity. So I kind of don't like I don't like shorting things. I really don't. It truly is speculation. It truly is reverse capital gain investing. And the other thing is the market can remain irrational longer than you can remain solvent. So, you know, when is it going to go down? I mean, you saw, they displayed this perfectly in The Big Short, where they had taken their short position and the prices were still going up. What's his name? Christian Bale's character. Prices were still going up, so his fund was going down. He was getting calls from his investors saying, I want my money out, we're losing money, and he kept riding the losses. That's an example. And the fundamentals were deteriorating. All of a sudden, defaults were coming in higher than expected. These mortgages were being defaulted upon. And you saw it. I remember this because, read my book, Behind the Housing Crash. Housing prices kept going up. Meanwhile, the fundamentals were deteriorating. Again, this huge disconnect, this huge decoupling between what's happening in the real world and the stock market. So the stock market was continuing to remain irrational, and you don't want to be in that pinched position that Christian Bale's character was in, where the stock prices are going down, where the housing and mortgage prices keep going up, and his position is getting hit because he was reversing the market. Now, in the end, lucky for him, the housing bubble did happen, but what if the housing bubble was a year late? A year later than that. That could have kept going on. Look at Australia. You want to talk about people going, I mean, because that's how Australians do it with an accent, and then a kangaroo jumps by. It's all true. So man, a stock market, or any market, can remain way more irrational and wipe you the fuck out if you're trying to short these positions. So am I okay shorting a few grand? It's not like you lose a few grand. If it goes way too much yellow, it could be 100 grand. So I would not. I'd be looking at look here. You want to know where there's investments where you have to worry, you can sleep soundly at night? Look for things that got cash flow. That's what I look at. I don't look at price. Well, I do look at price relative to earnings. I give you how much, and how much are you giving me back every year? I give you 100, you give me 5. Now I can do better on my own. I give you 100, you give me 10. All right, that beats what I can save on my mortgage. That beats what I can save on my student loans or my car loans. You got to look at what is the alternative investment. What's your next best use of that money? And if you can't get that in cash flow, meaning dividends and profits, not this, it might go up more. Then that's not how I invest. I invest. I don't speculate. I don't give the HR lady my money and say, I sure hope it goes up. I sure hope when I turn 65 it goes up. Like they say it goes up. What's the dividend? I don't know. Well, I reinvest those. Yeah, because you'll go up. Fucking morons. Thank you, and I appreciate your response. By the way, fun fact, you may remember Joel Greenblatt from the movie The Big Short. He was an older character who actually found and confronted Dr. Michael Burry about his investments when Burry made billions shorting the housing market, but I think they gave him a different name in the film. All right, cool. Well, that's nice. A little bit of trivia. So yeah, here, let me grab something. I know. No one's going to listen to the old Clairmeister, but we're going to try anyway, if I can find it. Nope, that's not it. Where the hell did I lose them all? Here. It's right there on the top. God damn it. This is a short book. Alright? This is a very short book, but the better part of one chapter explains the difference between an investment and speculation. And it also talks about the S&P 500, and it talks about how this fundamentally undermines our entire retirement system through our 401ks and IRAs. If you haven't bought, not just for my client, but if you're on this video for some reason and you're researching and, who's this crazy guy? This is a short essay. Well, okay, it's a long essay. It's a short book. It's dirt cheap. I think it's like $5 online, Kindle, and like $2.49 for Kindle. No, paperback is whatever. It's dirt cheap. You don't have to believe me. Just get this. And there's more stuff about how to retire cheap and all that other stuff because, among other things, the stock market is just insane. But yeah, so to my client, yes, that there really is no investing anymore. There really isn't. And what I would do is start looking at private investments you've made, namely paying off your debts, housing, because it'll save you rent. Again, you got to make sure the housing you're paying for is. I would stop looking at the public markets and publicly traded securities as the vehicle by which you're going to retire. I mean, you may have no choice because you get your tax deduction or whatever. You get a match, that'd be another thing to do. But yeah, man, I look at cash flow. I do not look at, oh my God, it might go up. And Greenblatt and Warren Buffett and the guys who do Value Line Survey and Peter Schiff and Schiller and Rubini and me, because I'm totally up there with those. They're all right. They're all right. Graham was right. It wasn't an opinion piece he was writing. It's that the rest of the economy and the market is wrong. And people say, well, it's pretty arrogant and cocky. It's like, oh, really? Do we have to have a fourth fucking crash? Really? Do we? I just let me know. Let me know. Because they don't learn. They do not fucking learn. And they have no incentive to learn. None of the parties in this market have any incentive to learn or to turn off that water spigot. They want it to keep going forever. Because it's just easy money. That's all it is. So. All right, you guys got questions, go to assholeconsulting.com. Get that book, Poor Richard's Retirement. It's available on Amazon. Audio, Kindle, paperback. And you can get all my other fucking books. Check out my blog, CaptainCapitalism.blogspot.com. What else? I don't know. Just check out my shit. I got it on the internet. We'll see you guys later. Toodles.